Money FM 89.3. Best of breakfast. The bigger picture, only on Money FM 89.3.
Good morning. Welcome to the bigger picture with me, Ryan Huang. We are kicking off today with a lot of market movement to unpack, from Trump's latest tariff decision to bank earnings reports and a major milestone in gold prices. So the question is, are we seeing the beginning of a deeper downturn or just a short-term correction? So let's dive into all that with Oriano Lizza. He is the sales trader at CMC Markets. Oriano, good morning.
Good morning, Ryan. Thank you for having me.
Great to have you on. So we've got lots to unpack, and you're pretty much right in the middle of it when it comes to following the latest headlines. Walk us through how markets are set up for this week, especially after the weekend where we had China saying they are not afraid of Donald Trump and the latest tariffs. Now, this is after Donald Trump imposed 100% tariffs on China.
Yeah, it was an interesting play by Donald Trump, obviously so late in the session on Friday, which I think was probably now, given hindsight, was a bit of a shock-driven sell-off as opposed to the start of a potential decline. I think what it does show, though, Ryan, is the fragility in the markets, the ability for, commentary and headlines to actually impact the market in such a negative way. I think we really need to wait, like you just sort of briefly touched on there, as to whether there is any retaliation from China and whether we see any sort of move from them. I think that might have a more impactful move in markets and maybe consolidate the correction a little further. From a market standpoint, I think obviously what we can see is there's been a slight recovery from those lows, both across the Asian session and also obviously in the US futures early this morning.
Yeah, so there's a couple of things that might be moving markets. One is what's playing out on the US-China trade front, where you have, for now, tensions rising. The other side of the equation is earnings, and that's where we've got banks kicking things off. What side of the glass, so to speak, are you looking at when it comes to earnings?
Yeah, I think with the current sort of market structure, what we're going to be looking at is net interest income versus fee income. So for a longest period during this heightened period in this heightened rate cycle, I guess what we've seen is obviously net interest income being the main benefactor. There's been some consolidation in the markets and a lot more deal activity from an M&A standpoint. So the banks will be looking to push that, I guess, rhetoric or narrative to obviously the market to maintain their what is pretty good performance. So one thing to look out for, I guess the big banks, they will probably benefit because they are diversified with lots of different arms and levers that they can pull. The regional banks will probably have a little bit more of a fight should interest rate cuts occur later in the year.
All right, we've also got the U.S. government shutdown as well that's potentially going to weigh on the U.S. economy. How much is that playing out for markets?
Yeah, I think it's somewhat sort of, I guess, factored in or baked in, as I like to say, in the markets. Obviously, one of the things is if it continues to stay shut down for a longer period of time, then we might obviously see a little bit more perceived risk from market participants. I think that's how the market is perceiving a lot of all these current shocks at the moment. How long are they going to go for, or are they just sort of slight corrections?
Yeah, I'm looking at the VIX index, and I think we just hit 22, which is, I believe, a 6-month high. So lots of volatility. How much is that going into safe havens like gold, which has broken new highs, breaking above 4,000 recently?
Yeah, no, it's a great point you sort of touched on there, Ryan. I think that in the gold market or the real yield market, we could probably call it, is there's been a bit of a perfect storm. There's geopolitical tension, there's expectation of rate cuts, and obviously US dollar. So on top of that, from an institutional or governmental perspective, there's also a lot of central bank buying. So something that a lot of people are talking about from that standpoint is this a move away or a de-dollarization play, or just more of a structure cyclical play from the sort of retail partners? So I think they need to be looked at from very different perspectives, from the institutional and the government side, as well as obviously the safe haven or risk assets. I think this will sort of continue in terms of these heightened levels. Just looking across commodities earlier this morning, I can see gold and also silver sort of trending, and platinum sort of trending sideways. So they may have found a level initially, but what we will probably see in terms of fund flows is still into some ETFs and central bank reserves going forward whilst uncertainty remains.
Yeah, how much does the US dollar play into this equation where you've got the prospect of it weakening?
I mean, it's a big driver, isn't it? Yeah, and I think so. That's where governments are looking to move away, especially in the kind of BRICS countries and maybe emerging markets are having reserves in gold as opposed to US dollar. So they need to find that balance as to, what is that sort of perfect sort of equilibrium in their holdings. A lot of EM countries, unfortunately, do have US dollar denominated debt. So it could actually work in their benefit that actually the rate of payoff or the rate of return back to or clearing those debts, as well as having the, yield upside from gold, might actually help them. So that's what they're probably trying to move away from and looking for an alternative to the dollar.
All right, lots to keep track of as we look forward to the week, and helping us out this morning, Oriano Lizza. He is the sales trader for CMC Markets. Oriano, thank you so much for your time and insights.
Thank you, Ryan. Thanks for having me.
All right, always great having you on. Stay at Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.
Money FM 89.